Oil just hit $100 and your portfolio is on the line. The surge in oil prices is a wake-up call for investors. With oil at $100 per barrel, the effects of war and inflation can't be ignored. You'll learn how this impacts your investments and what to do next. Oil prices have surged to $100 per barrel, a 25% increase in just 6 months. This is a direct result of the war in Ukraine and supply chain disruptions. For investors, this means a potential hit to their portfolios. The S&P 500 has already seen a 10% decline since the start of the year. And with oil prices expected to stay high, the impact on the stock market could be significant. For example, if you have a $10,000 investment in the S&P 500, you could be looking at a $1,000 loss. But that's not all. The effects of high oil prices will also be felt in your daily life. With gas prices up 20% in the past year, your commute to work just got more expensive. And with inflation on the rise, the cost of living is increasing. So, what can you do to protect your investments? One option is to diversify your portfolio by investing in oil-producing companies like ExxonMobil or Chevron. These companies are likely to see an increase in profits as oil prices rise. But it's also important to consider the potential risks. If oil prices were to drop, these companies could see a decline in profits. And, as we've seen in the past, oil price volatility can be unpredictable. So, it's essential to do your research and consult with a financial advisor before making any investment decisions. But the part that surprised me most is what this does to your retirement savings. That's next. But the part that surprised me most is what this does to your 401k. And it's not just about the money you've saved, but also the purchasing power of that money. Imagine having to pay 10% more for the same retirement lifestyle. That's what we're going to explore next. You'll learn how to protect your retirement savings from the impact of high oil prices and what steps you can take to ensure your golden years are secure. The surge in oil prices is not just a short-term problem. It also has long-term implications for your retirement savings. With oil prices expected to stay high, the cost of living is likely to increase, which means your retirement savings may not go as far as you thought. For example, if you have a $500,000 retirement fund, a 10% increase in the cost of living could mean a $50,000 reduction in your purchasing power. And with inflation on the rise, the value of your savings could be eroded over time. But there are steps you can take to protect your retirement savings. One option is to invest in inflation-indexed bonds, such as TIPS. These bonds are designed to keep pace with inflation, which means your savings will be protected from the effects of rising prices. Another option is to consider investing in dividend-paying stocks, which can provide a steady stream of income to help offset the effects of inflation. Back in 2008, we saw a similar surge in oil prices, and many retirees were caught off guard. But this time around, you have the opportunity to prepare and protect your retirement savings. For instance, a $10,000 investment in TIPS could provide a 3% annual return, which could help offset the effects of inflation. So, it's essential to do your research and consult with a financial advisor before making any investment decisions. And the historical comparison is striking. The last time oil prices surged like this, the stock market saw a significant decline. But what's different this time is the global economic landscape. That's what we'll explore next. But what's different this time is the global economic landscape. And it's not just about the US economy, but also how other countries are responding to the oil price surge. You'll learn how this global response could impact your investments and what to do next to stay ahead of the curve. Specifically, you'll discover how countries like China and India are positioned to benefit from the shift to renewable energy and how you can invest in these emerging markets. The surge in oil prices is not just a US problem, it's a global issue. With oil prices expected to stay high, the impact on the global economy could be significant. For example, if oil prices were to stay at $100 per barrel, the global economy could see a 1% decline in growth. And with many countries still recovering from the COVID-19 pandemic, the impact could be even more severe. But there are also opportunities for investors. With the shift to renewable energy, companies like Tesla and Vestas are well-positioned to benefit from the transition. And with the growth of emerging markets, countries like China and India are likely to see significant economic growth. For instance, investing in the Indian stock market could provide a 10% return, but it also comes with a higher risk of volatility. So, what can you do to take advantage of these opportunities? One option is to invest in a globally diversified portfolio, which can provide exposure to a wide range of countries and sectors. Another option is to consider investing in emerging markets, which can provide higher returns but also come with higher risks. However, it's also important to consider the potential risks. If the global economy were to decline, the value of your investments could be impacted. Back in 2015, we saw a similar decline in oil prices, and many investors were caught off guard. But this time around, you have the opportunity to prepare and protect your investments. A common misconception is that investing in emerging markets is too risky, but with the right strategy, it can be a lucrative opportunity. So, it's essential to do your research and consult with a financial advisor before making any investment decisions. And the surprising second-order effect is the impact on the US dollar. That's what we'll explore in our final section. The surge in oil prices has a surprising second-order effect, the impact on the US dollar. With oil prices expected to stay high, the value of the US dollar could be impacted. For example, if oil prices were to stay at $100 per barrel, the value of the US dollar could decline by 5%. And with the US dollar being the global reserve currency, the impact could be significant. But there are also opportunities for investors. With the decline of the US dollar, investors can take advantage of the weakness by investing in currencies like the euro or the yen. Another option is to consider investing in gold or other precious metals, which can provide a hedge against inflation and currency volatility. A common misconception is that a weak US dollar is always bad for the economy, but that's not necessarily true. A weaker US dollar can actually make US exports more competitive, which could lead to an increase in economic growth. For instance, in 2016, the US dollar declined by 10% and US exports increased by 5%. So, it's essential to do your research and consult with a financial advisor before making any investment decisions. Additionally, the impact on the US dollar could also affect the value of your international investments, so it's crucial to consider this when making investment decisions. Historically, a weak US dollar has led to increased investment in emerging markets, which could provide higher returns. But it's also important to consider the potential risks. If the US dollar were to decline significantly, the value of your investments could be impacted. So, it's essential to have a diversified portfolio and to consult with a financial advisor to navigate these complex investment decisions. In conclusion, the surge in oil prices has significant implications for investors. With oil prices expected to stay high, the impact on the stock market and the global economy could be significant. To protect your investments, consider diversifying your portfolio and investing in oil-producing companies or inflation index bonds. And don't forget to consult with a financial advisor before making any investment decisions. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about oil prices, hit subscribe. I break down one of these every week. Take action now and start protecting your investments from the impact of high oil prices. Start by reviewing your portfolio and identifying areas where you can diversify and reduce your risk. Consider investing in a tax-advantaged retirement account, such as a 401k or IRA, to maximize your savings. And if you're not sure where to start, consider consulting with a financial advisor who can provide personalized guidance and help you create a plan to achieve your financial goals. By taking these steps, you can ensure that your investments are protected and that you're on track to meet your long-term financial objectives.